Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial secrets that move the market, and today we are diving deep into Trimass Corporation's latest quarterly report. It looks pretty interesting with some big swings in their business segments, so let's see what those numbers really mean, and if this company is setting itself up for success or a stumble. Before we dive headfirst into the financials, make sure you hit that subscribe button and join our Discord community linked in the description below. Alright, let's get straight to it. Trimass Corporation's latest filing for the quarter ending, the 30th of September 2025, tells a story of change and strategic moves. Looking at the consolidated balance sheet for the 30th of September 2025, Trimass has total assets of about $1.43 billion. That is a healthy increase from the $1.32 billion at the end of 2024. Their cash and cash equivalents saw a nice bump up to $33.6 million from $23 million, which is a great sign of financial health. However, their goodwill also significantly increased to $387 million from $356 million. This usually means they have likely made some acquisitions and are paying a premium for them, which carries its own risks. Now let's talk about sales, the lifeblood of any company. For the 3 months ending the 30th of September 2025, Trimass reported net sales of $269.3 million. That is a notable jump of almost $40 million from the same period in 2024. The 9-month period also shows strong growth, reaching $785.7 million compared to $697 million in the prior year. This is driven by growth in their aerospace and packaging segments. The packaging segment saw sales creep up by about 4.2% to $135.7 million for the quarter. This growth feels a bit modest but steady. On the flip side, their gross profit actually dipped slightly due to about $1.5 million of inventory written down and increased material costs. This is a red flag showing that while sales are up, profitability per SAL is being squeezed. The aerospace segment is where things get really interesting. For the third quarter, sales there shot up by a massive 45.8% to $103.2 million. This growth is a mix of organic expansion and a recent acquisition. The GMT Aerospace business, their gross profit margin in this segment also saw a big improvement, jumping from 23.3% to over 30%. This is fantastic news, showing they are either gaining pricing power or controlling costs much better in this sector. The specialty products segment shows a more mixed picture. Sales grew by 7.2% in the quarter to $30.3 million, driven by their steel cylinders, but this was impacted by the divestiture of their Aero engine business. While sales are up, the gross profit margin in this segment actually decreased, indicating that the core cylinder business might be facing higher costs or a less favorable sales mix. Digging into corporate expenses, they increased significantly for the quarter to $22.3 million from $18.3 million. A big part of this increase is an $8 million charge to update their asbestos liability estimates, which is a reminder of the long-term legal baggage some companies carry. Speaking of that asbestos liability, the company has set aside about $36.6 million to deal with these claims. It is a chunky number, and they are continuing to reassess this estimate, which means it could go up or down. They are also starting to see some insurance carriers step in to handle these costs, which is a positive development in managing this long-term issue. Looking at equity awards, stock-based compensation expense related to ASUs was around $7.5 million for the 9-month period. This is an important cost to consider as it dilutes existing shareholders' value, but also aims to incentivize key employees. Now, for the bottom line impact, net income for the third quarter of 2025 was $9.3 million, a huge leap from $2.5 million in the same quarter last year. For the 9-month period, net income more than doubled to $38.4 million from $18.6 million. This is largely thanks to the strong performance in the aerospace segment and a lower effective tax rate. Interest expense saw a decrease, which is always good to see. For the 9-month period, it dropped to $13.4 million from $15 million, signaling either lower debt levels or better interest rates. Their long-term debt structure is interesting. They have $400 million in senior notes due in 2029. While the carrying amount is at par, the fair value has actually decreased from $365 million to $386 million, which is a bit counterintuitive given current market conditions. But fair value accounting can sometimes be tricky. This is a crucial point. Trimass total net leverage ratio is 2.29 to 1. This is well below their covenant requirement of 4 to 1, meaning they have a lot of room to take on more debt if needed, perhaps for more acquisitions or to weather economic storms. In their forward-looking statements, Trimass acknowledges a lot of risks. They are concerned about economic conditions, tariffs and trade actions, supply chain issues, and raw material costs. They also flag risks related to their international operations and environmental regulations. This shows a realistic view of the challenges ahead. So, what is my take on TRIMAS? They are clearly navigating a complex economic landscape with some impressive wins, particularly in their aerospace segment, which is showing significant growth and improved profitability. The packaging segment is steady but facing margin pressure, and specialty products need careful watching. The company's strong balance sheet and favorable leverage ratios provide a solid cushion. However, the impact of tariffs, supply chain volatility, and the persistent asbestos liabilities are real headwinds they will need to continue managing effectively. Overall, TRIMAS appears to be executing a strategy of growth through acquisition and operational improvement, but investors should keep a close eye on input cost management and the profitability of each segment. What are your thoughts on TRIMAS's performance and their strategy moving forward? Let me know in the comments below if you found this deep dive valuable. Please give this video a like and subscribe to Corporate Decoder for more analyses that get straight to the point. Also, don't forget to join our Discord community to keep the conversation going. Thanks for watching, and we'll see you next time.